Welcome to the Explainer. Today, we're going to build out the essential toolkit that every single investor needs to make sharp, objective financial decisions. We're going to cut right through the noise and get straight to the methods that really work.
So let's start with the big one, right? You've got a great idea, you've got some capital just sitting there ready to go. But how do you really know if it's a good investment? Because let's be honest, gut feelings are great, but they don't always build wealth. You need a way to look into the future and decide with real confidence if this whole venture is actually worth your time and your money. Well, to answer that question, we need our first tool. And honestly, it's the most important one. It's what the pros consider the absolute gold standard for figuring out value, net present value, or you'll just hear it called NPV. So, what exactly is NPV? The definition sounds a bit academic, but the idea behind it is, actually, it's kind of magical. It does one amazing thing. It takes all the money you think you're going to make in the future, and it tells you exactly what that pile of cash is worth to you right now, in today's money. It's the bottom line net benefit of an investment.
And the best part? It's not just some vague concept. There's a process. It's a clear 5-step method to get to that number. You basically map out all your cash, what comes in, what goes out. Then you figure out your discount rate, which is just a fancy way of saying, what could I earn on my money somewhere else? And then you crunch the numbers to bring it all back to today. It turns this messy future into one single decisive number.
And once you have that number, the rule is just beautifully simple. If your NVP is positive, you do the project. That's it. It means the investment is worth more than it costs. If it's negative, you walk away. No gray area. It's a crystal clear signal.
Okay, let's make this real. Imagine a project. It's going to cost you, say, $2 million up front, but you expect it to generate cash for the next few years. You do the math, you run through those 5 steps, and out pops this number, $88,655. That positive number is your green light. It's objective proof that this project is going to make you wealthier. You go for it.
Okay, so NPV is the gold standard, but it's definitely not the only tool in the box. Let's talk about another really popular one. Maybe one you've heard of more often. It's the one that gives you that nice, clean percentage that's so easy to talk about. The internal rate of return, or IRR.
So what is IRR? Well, you can think of it as the project's own, built-in interest rate. It's answering a slightly different question than NPV. It's asking, at what exact discount rate would this project just break even? Where the NPV would be exactly 0. It's the project's tipping point.
And just like NPV, the rule for IRR is pretty intuitive. You just compare the project's IRR to your opportunity cost, that return you could get elsewhere. If the project's IRR is higher, you accept it. Simple enough, right?
So, we've got 2 great tools. They both seem pretty straightforward. But here's where it gets interesting. What happens when you're not just saying yes or no to one project? What if you have to choose between 2 good options? And these 2 tools give you completely different answers. All right, let's look at a classic textbook dilemma. We've got 2 projects, A and B. They're mutually exclusive, which just means we can only pick one of them. Now look at the numbers. Project A has an absolutely massive IRR of 50%. Project B's is lower at 40%. But, and this is key, Project B is a much bigger investment. And right there, that's the conflict. The IRR rule is screaming, pick Project A, 50% is bigger than 40%. But the NPV rule, which is focused on the total dollars and cents created, is saying, whoa, hold on, Project B creates way more actual wealth. So, which one do you listen to?
When you just look at the raw numbers, the chart makes it so obvious, doesn't it? Project B literally adds more than double the amount of actual money to your pocket. And that's the whole point. You can't go to the store and spend a percentage point, but you can definitely spend those extra euros from Project B.
And this gets to the absolute heart of the matter. IRR is just a rate. It's a percentage. But NPV is wealth. It's a dollar amount. And at the end of the day, the entire goal of investing is to maximize wealth. So a super high percentage on a small project just can't beat a really good percentage on a much bigger one. The takeaway is simple. When NPV and IRR disagree, you go with NPV every single time.
Okay, so you've used NPV, you've picked the right project, awesome. But the story isn't over. Let's fast forward a bit. Your investment is up and running. Now you've got a whole new problem. How do you actually measure how well it's doing, especially if you've been putting more money in or taking some out along the way?
This happens all the time, right? Look at this timeline. An investor buys 1 share.
A year later, the price has changed and they buy another one. Then, later on, they sell both. Now, how do you calculate a simple return on that? It's tricky, because the amount of money you had working for you changed halfway through.
Well, one way to do it is with something called the money-weighted return. If you run the numbers for our investor, you get a return of 9.39%. And what's interesting is this calculation is basically just another IRR. It's an IRR that takes into account all your personal decisions about when you put money in and took it out.
But hold on. If we use a different method called the time-weighted return on the very same investment, we get a higher number, 10.76%. So what gives? Why are there two different answers? And which one is the right one?
Okay, this difference is absolutely critical to understand. The money-weighted return is all about your performance, and it gets heavily skewed by when you decided to invest more money. Our investor, for example, added more cash right before a not-so-great year, and that dragged their personal return down. The time-weighted return, on the other hand, completely ignores that. It strips out the timing of your decisions and just measures the pure, underlying performance of the investment itself. It's like asking, how did the manager do, not how did my timing affect my results?
And that's exactly why the time-weighted return is the standard across the entire investment industry when you're evaluating a fund manager. It's the only fair way to judge their skill at picking stocks because it separates their performance from their clients' decisions about when to give them money or take it away. It's the only true apples-to-apples comparison.
All right, so we've been through cash flows, discount rates, and different kinds of returns. Let's step back and pull it all together. What are the key things you absolutely need to have in your own personal investor toolkit?
Let's boil this all down to a few simple rules. First, use net present value, NPV, to look into the future and decide if you should invest in something. It's the best, most reliable way to measure how much actual wealth a project is going to create. And remember, if NPV and IRR ever tell you two different things, you listen to NPV. Then, for looking back at how things went, you use the time-weighted return. It gives you the truest picture of how an investment actually performed, without your own cash flow timing messing up the numbers.
And, this whole way of thinking isn't just for big shots on Wall Street. You can apply this to almost anything. Thinking about starting a business? Use NPV. Buying a rental property? NPV. Wondering if that expensive master's degree is worth it? You can use NPV for that too. So the real question I want to leave you with is this. Now that you have these tools, what ideas floating around in your world can you look at with fresh eyes? Which ones are secretly creating value and which ones are destroying it?
Thanks so much for joining us for this explainer. The goal was to give you the tools to make smarter, sharper financial decisions. Now you have them. Go use them wisely.